Hello, with me today, so we have Mr. Allan Vun. He's the CEO of Warren Capital. Hi, Mr. Warren Allan Vun. Okay, so first of all, can you tell me what Warren Capital is all about?
Basically, we conduct non-advisory research and consultancy in the area of equity derivatives like warrants, options, and futures, things like that. We also publish books and investment educations, seminars, things like that. More catered towards investor education.
Can you tell me what makes you choose stocks and what is the main difference between stocks and forex market?
Okay, shares or equity stocks is a different asset classes in forex. Forex, you are dealing with very fast-moving markets and 24/7 kind of environment. Whereas stocks, there's a little bit more, what do you call it, micro that you need to look at, like for example, individual stocks, earnings and things like that. So these are a little bit more specific, and you can choose to trade certain stocks. Unlike forex, whereby you only have a limited choice of pairs, currency pairs. Also, stocks, you are able to actually discover companies that are able to generate substantial profit growth and hence translating into a higher price growth over the next few years. So it's, in that case, it is something that is more, I would think, more manageable for investors, that you can actually come and do some outperformance over the general market over a longer term.
So in your own opinion, which one did you think that is more risky or safer?
Actually, whether some asset is riskier or safer, it all depends on how you manage your portfolio or your money. I can't say that stock is more risky than forex, because if you are actually involved in a non-geared product, forex only movement is very little in terms of percentage movement. But if you actually choose leverage products like CFDs or trading forex, as in coming up with a margin and things like that, so you are dealing with very big gearing. So gearing can amplify gains or losses. So in that case, to most people, because usually when they trade forex is on a very high gearing kind of positions, that's why it seems a bit riskier. Whereas for stocks, if you buy, even if a non-geared, the volatility is actually higher than forex. But because most people buy stocks on ungeared, that means they buy the stocks, that's it. They don't go on share financing, or even if they choose to, they can actually go for warrants, options, things like that. But even if they only buy stocks, the volatility is actually much higher. But the amount invested, because it's ungeared, then it would be, even though it's more volatile, but maybe if you are invest in a very highly geared forex product, then even the volatility of the underlying forex is low, but because of the highly geared position, then it becomes very risky. Okay.
So this will be my last question for you.
Okay.
So what is your expectation in this field, and then do you have any advice for all the traders out there?
Expectation as in the kind of profit potential, things like that?
Yes, something like that.
Okay. Actually, when you start to trading, you probably would be a little bit more aggressive. So it will be employing strategies that are, what I call it, riskier. During that period of time, you would probably conservatively, if you're talking about stocks, return shouldn't be that high. It would be 15-20%. Would be per annum, would be very, very high for normal equity investing. But myself, I would probably invest a little bit more in warrants or options, this kind of equity derivatives that would actually amplify your return if you're right, of course, hopefully. So basically a 20% return in the underlying stocks could actually translate to a 100% gain in the instruments that are used to participate in the 20% growth of the stocks.
Okay.
So maybe a reasonable target. Actually it varies between year to year, but I think probably 20 to 50% kind of return would be compounded, would be pretty good.
So do you have any advice for the traders?
For the traders, actually, at the end of the day, no matter what products you choose, or what, whether you're right or wrong in your buying or selling, I think the most important factor to consider is your risk management, as in money management. So if you actually, say for example, invested a substantial amount of your money into a product, then your psychology get affected, and that would actually prompt you to commit possible errors because you actually had too much to lose. But if you actually manage your capital properly, whereby you can afford to lose that amount that you have invested, then your mind will be more stable and you will be able to generate better decision making. So I think the rule of this thing is that when you actually invest in something, make sure that if you lose the money, it doesn't change your lifestyle. If it does, then probably you are actually investing too much.
Okay, I think that's all for today. Thank you, Mr.
Okay,
Allan
thank you.
Wun. See you.
Thank you.